Kevin Warsh just held his first Fed meeting, and the headline is not that rates stayed unchanged. The headline is this: the Fed may be changing the way it talks, the way it reads data, and the way markets price the future. That matters far more than one rate decision. Don't just watch the rate. Track the reaction function. The Fed held rates in the 3.5 to 3.75% range. Markets expected that. So if you are only asking, did they cut or pause? You are already late. The real question is, how will this new Fed chair respond to inflation, energy shocks, AI productivity, the labor market, and market volatility? Because every Fed chair has a reaction function, Powell had one, Warsh is now showing his. The first major signal: forward guidance is being pulled back. For years, markets became addicted to Fed hints, dots, projections, carefully worded statements, tiny changes in language, but Warsh appears skeptical of that system. He does not want the Fed pre-committing to a path it may not be able to deliver. That means markets may have to price incoming data more directly instead of simply asking, what did the Fed tell us to think? This sounds cleaner, but it also means more volatility. Less guidance means less comfort. The second signal: the Fed may rethink the data itself. Warsh talked about old survey methods, delayed data, revisions, and the problem of making real-time decisions with information that often looks backward. That is a huge shift, because if the Fed starts using faster data, private sector signals, and AI-driven analysis, monetary policy could become less backward-looking. That would be a very different Fed, not perfect, not automatically dovish, but potentially faster, more adaptive, and more focused on trends instead of stale data points. The third signal is productivity. Warsh clearly sees AI as one of the biggest economic forces of this cycle. This matters because AI creates a complicated problem for the Fed. On one side, AI increases demand: data centers, chips, power, infrastructure. That can be inflationary, but over time, AI may also increase supply and productivity. That can be disinflationary. So the Fed is now watching a race: demand today versus productivity tomorrow. And that race will shape how restrictive policy really needs to be. So what should investors actually watch after this meeting? Not the pause. Watch three things. First, does the Fed really abandon forward guidance? Second, does it modernize how it reads data? Third, does Warsh treat AI productivity as a reason to tolerate lower rates, or as a reason to stay cautious because demand is still too hot? That is the new map. The market wants a simple answer: bullish or bearish. That is the wrong question. The right question is, what is the new Fed reaction function? Because when the Fed changes how it reads the economy, every asset reprices: stocks, bonds, Bitcoin, gold, risk assets. The rate decision was the surface. The reaction function is the flow. Don't just watch the news. Track the flow.